ETC.
ATC.
ATC, there are no changes at all. Sorry, somebody has raised the question that whether there are any changes in ATC. There are no changes in ATC. Okay, we go to IFSC. Again, one more thrust area where government is working very hard to give all the sorts of benefits to IFSC. One of the benefits that is sought to be granted is the exemption from capital gains on transfer of GDR rupee denominated bonds extended to category 3 alternative investment funds in IFSC. So as we know, alternative investment funds are very active in this kind of setup of IFSCs, wherein they buy GDR or rupee denominated bonds uh, on a very large scale. As we discussed, IFSC is considered to be a territory outside India, and alternative investment funds are also a non-resident non-resident person. So obviously, they would like to take benefit of income tax, as income does not get accrue or arise in India, but there were no specific provisions available under the Income Tax Act. So these was getting taxed. Whenever there are transfer taking place in GDR or these bonds, there is obviously some capital gain which is getting accrued, and this was getting taxed so far. Now, the benefit of exemption of capital gains is sought to be given to these GDRs or rupee denominated bonds, so that more investments can be brought in through alternative investment funds in IFSC. Other than this, there are ECBs which are which are borrowed by the units in IFSC, and they regularly pay interest on these ECBs to the lenders. Now, going forward, whenever IFSC is taking loan on account of ECB after 1st of September 2019, and interest is paid to these ECB holders, then in the hands of ECB holder, this interest which is paid by unit in IFSC would become tax free. Now, I fail to understand why this is sought to be done after 1st of September 2019. If benefit was required to be given or is sought to be given, why not to give it right from today, when ECB can be contracted by IFSC, unit in IFSC, and they can start doing business right now. But then, in their own wisdom, they have decided to give the date of 1/9/2019, and that is what is given in the law, and we have to accept it. Next is IFFCs who have set up their shop at various places in India. And by its very nature, the IFSCs don't start making profits in the initial years. And the 10-year of exemption which was given to them is getting washed away for next few, because initially 2, 3, 4 years they are not able to make profits, and hence tax benefit granted to them is not getting actually enjoyed by them. So in order to give them the full coverage, full benefit of the exemption granted, they are given the choice of 10 consecutive years out of first 15 years of their existence. So effectively, if one starts making profits, say from third year or fourth year, and if their brought forward losses are getting adjusted, then they can opt for getting exemption from fourth year onward, and till 14th year, they would be able to enjoy the exemption. So it is again a very good move on the part of government to give them maximum benefit, which was intended to be given to them. Then there is one more exemption which is given to IFSCs, and that is under section 115R, whereby 5% additional income tax is required to be paid on the income distributed by the specified mutual funds in IFSC. So, whenever there is any income derived from the transactions which are made on the recognized stock exchanges located in IFSC, the 5% of additional income tax which is required to be paid by mutual fund would get exemption. The mechanism for the same, for actually deriving where from these income distribution is made is required to be specified properly. And once it is proved that the amount is distributed out of income derived from IFSC, then there would not be any additional tax required to be paid by the specified mutual funds. That was on IFSCs. Now we go to next point, where the buyback of shares by a listed company. As we all know, all the closely held companies or unlisted companies, under the current proviso, under the current law, was required to pay 20% additional tax on the amount paid to shareholders through buyback. This was not applicable to listed companies. So listed company used to buy back those shares without paying any extra amount to the shareholders or to the government, and shareholders were also getting exemption, and only capital gain was required to be paid by shareholders. Now under the proposed amendment, listed companies are sought to be included in the list, whereby the 20% of additional tax will have to be paid by the listed companies also. The mechanism of amount or the additional tax of 20% to be paid remains the same. That is, the amount which is paid by the company to the shareholders for buyback, less the amount received by company on allotment of these shares, would be the principal amount on which 20% additional tax will be required to be paid. And this, of course, is effective. Whenever government wants to mobilize the resources, it comes from effective date of the same date of presentation of budget, and this is no exception. So effective from yesterday, from 5th of July, when the budget was presented, this additional amount, additional tax would be required to be paid by all the buyback by a listed company. Next change is very important change. It is something which was already there on the statute book. Part of that is again sought to be included in the statute. As we know, a person is required to file the return of income if his income exceeds the maximum amount not chargeable to tax, which is 2.5 lakhs currently. All the companies and partnership firms are necessarily required to file the return irrespective of their income. So whenever any individual decides to file the return, he has to see whether his income is taxable or not. So based on this, one used to decide. One of the important thing which was considered or which was prescribed was that it is total income. So effectively, even if there are large transactions on sale of properties and purchase of property by a taxpayer, wherein crores of rupees of income was generated and claimed exempt by utilizing those proceeds and claiming exemption under section 54, under various subsections of section 54, the income was again coming to a less than the maximum amount not chargeable to tax, and hence they were not required to file the return by law. Now what is sought to be amended is that whenever there are any deductions claimed under, say, various subsections of 54, Mind well, ATC and the deductions which are available under Chapter 6A would be available to them, but whenever there are any large transactions and benefit of Section 54 is taken, so they will be obliged to file the return of income irrespective of whether the tax is payable by them or not, and whether the income chargeable to tax is exceeding the threshold limit. Other than this, there is one more couple of few other categories which are added on filing of return of income, compulsory filing of return of income. That is deposit in current account in bank exceeding rupees 1 crore. So we saw some TDS required to be deducted when cash is withdrawn from the bank. Similarly, whenever there are any deposits in current account, so actually when you are carrying on business and there are deposits exceeding rupees 1 crore in a bank account, one is required to file the return compulsorily despite the fact that he is not having taxable income. Other than this, two more categories are added, which is very important, and probably many taxpayers would have to file their return. Many SSCs would have to file their return, those who have obtained PAN. There is a large category of PAN holders who are not filing their return because their income is less than the amount chargeable to tax. But whenever they incur any expenditure of foreign travel, which is exceeding 2 lakhs rupees, he will have to file the return based on the expenditure. Now, the foreign travel amount which is paid is not only for himself, but if he is taking along with him any of the family members and he is incurring these expenditure, then also the limit of 2 lakhs rupees will have to be included therein. Other than this, there is one more category of electricity consumption exceeding rupees 1 lakh. So effectively, whenever somebody is spending about average of more than 8.5 lakhs, 5,000 rupees per month on electricity bill, then even if he is not having taxable income, he will be obliged to file the return of income. So these were the few categories which were included in the obligations to file the return effective from assessment year 2021. Other than that, there is one more important change which has taken place, and that is interchangeability of Aadhaar and PAN. As we know, there are, many places where one has to file their PAN, and there are large transactions which are happening which cannot be undertaken without PAN. But there are people in India who are having only agricultural income and they are not required to obtain PAN, and they have not actually obtained PAN. So how does government catch hold of them when there are very huge volume of transactions? So what is sought to be done now is that Aadhaar is also to be taken as the equivalent of PAN, and whenever PAN is required to be given, one can always give the Aadhaar, and based on Aadhaar, one can also file the return. Now, probably the scheme or the actual mechanism of using Aadhaar in place of PAN would obviously be prescribed by the law. But then, as it is announced in the budget, Aadhaar can be used in place of PAN at all the places, irrespective of whether it is income tax or any other outside agencies. So that this is very important change wherein government would be able to track a lot of transactions through Aadhaar also. Next is tax deduction. Now, what are the changes in respect of tax deductions which are sought to be included in the amendments which are proposed? As we know, LIC policies, the proceeds of LIC policy on maturity, which is received by the policy holder on the life insurance, is exempt normally. But this exemption is not available to them when the premium payable on these policies were more than 20% of the sum assured, the capital sum assured. Whenever a person gets benefit of this or buys a insurance policy wherein amount paid is less than 20% of the capital sum, the amount received at the time of maturity of this policy is not exempt. And under the existing provision, 1% of the amount paid to the policy holder was getting deducted by the insurance companies. Now, having realized that this 1% cannot be a proper yardstick, the finance bill proposes to change it effective from 1/9/2019, whereby the insurance company is required to deduct tax at the rate of 5% instead of 1% on the income comprised therein. So, effectively, instead of the principal amount that is being paid, insurance company will have to work out exactly what is the amount of income that is comprised therein. For example, a policy of 1 lakh rupees is getting paid for 1,25,000 rupees, which conforms to this. Then currently, the tax deduction of only 1% on 1,25,000 was taking place. But under the new proviso, it will be 5,000 rupees based on the income comprised in the said maturity. So 1 lakh rupees of premium paid becomes 1,25,000. So income which is comprised in the maturity proceeds is 25,000 rupees, and 5% of that would be deducted as tax by the insurance company. Other than this, there is one important change which is sought to be done is in respect of tax deduction of 1% that we are making for purchase of immovable property, value of which is exceeding 50 lakhs of rupees. Under the current proviso, whatever is agreement value for the purchase of house property only was the principal sum on which SSC was required to deduct tax at the rate of 1%. But there are many other payments which are made when the house property is purchased, which are for car parking, club membership fees, other charges which are there, the one-time maintenance is getting paid. So number of other payments are normally made by the purchaser of house property, but those were not getting covered under the existing provisions of 194 IA for deduction of tax. All these amounts would now get included in the taxable principal amount on which tax is required to be paid. But the rate of tax of 1% continues to remain the same. There is no change in that. But these amounts, additional amounts which are paid to the developers or to the seller of the property would have to be included for this purpose. One important change is one more change which is very important from the perspective of the SSCs who are not actually required to deduct tax and pay taxes for payments which are made for personal use. For example, if somebody who is not otherwise doing business, a salaried class employee who is making investment or renovating his house or making his house, whereby he is making payment exceeding 50 lakhs of rupees for to the contractor. He was under the current proviso not required to deduct tax on these payments. But under the proposed provision, any payment which is made by individual or HUF who is not otherwise required to deduct tax is required to deduct tax at the rate of 5% on all the works contract or professional fees exceeding rupees 50 lakhs per annum to a resident person. So effectively, to my mind, if there are contracts, different contracts of 10 lakhs rupees each, and there are 6 different contractors, the liability to pay tax would not be there. But if it is paid to one contractor, then 5% of the amount would have to be deducted from the payment to be made to them and will have to be deposited with the government. Of course, there is no need for them to obtain tax deduction account number, and based on their PAN, they would be able to pay these taxes, which is a saving grace for those who are covered under this. Uh, then we go to the banking cash withdrawal exceeding rupees 1 crore, which is already covered by us for under the digital economy points, and we already discussed this, so I am not giving more time on this. Then we go to penalties for failure to file the return. Under the current provision, whenever there are notices issued under section 48, that is reopening taking place, or when person has not filed a return, but the government realizes that there are transactions which have happened in his account, which is available to them based on various reports available with them, and a notice is issued to a person, to a taxpayer under section 148, and he files the return, and after filing the return, it turns out to be taxable income for him, and hence he was originally supposed to file the return, but he did not file it. But under the existing penal provisions, these cases were not covered. Whenever return is filed in response to section 148, the penalty was not liable to be levied. Realizing this, the government has included these kind of categories for penalty, and these provisions are introduced in the finance bill, and which would be effective from retrospective date of 1/4/2017. So that is effective from assessment year 2017-18. So these were few provisions which we discussed, which I felt were important for kind of the audience that we have right now, and I have tried to cover as much as possible and try to give my best. I hope everyone has understood it in the right perspective. And I thank all of you for your active participation. And I would take questions, if any, right now on anything that we have covered.
Yeah, I think Amit bhai, you did an amazing job. It was a nice session for all of us. We got a lot of perspective on section-wise breakup of the direct tax changes that have come in the finance bill. We kind of also got an update on the vision that the Modi government has set with respect to the startups, the home buyers, the digital India, and so on. It was a good session overall. I would request everyone to reach out to Amit bhai directly if you have any queries. His email ID is displayed in this website, this slide, amit@apmh.in, and his mobile number. It will be preferred if you reach out on the WhatsApp, so that then he can answer you comfortably whenever he is available. We at APMH keep on endeavoring a lot of new ideas with respect to knowledge on the direct and indirect tax side. We also continue to deliberate on a lot of business issues with the business owners would have. We have evolved as a team since last 30 years, which is knowledge oriented and focused towards educating the customers and simplifying the matters for them all the time. This was one of the sessions in this respect. We keep on having webinars on different topics whenever we feel it is relevant for our customers and our corporate community at large. So keep in touch with us. Go through apmh.in. We list the events on apmh.in all the time with respect to new upcoming changes, and educate the people who join our webinars, and kind of be in touch with them. With this, I want to thank you on behalf of the APMH team for attending this amazing session. Be in touch. Have a great time ahead. Thank you.
Thank you. Thank you everybody for attending.